Hello, my name is Chris Key, and I'm going to be talking about corporate and business level strategy for Unify Incorporated today. I've not worked for Unify, but I chose them because they have been successful during the tough times for textiles in the U.S., and I've seen them shift their strategy as needed when business conditions demand it. Unify was founded in 1971 by Alan Mebane. They're headquartered in Greensboro, North Carolina. And their original business consisted primarily of polyester yarn, and they had a low-cost strategy where they used optimized machinery and processes. Now, Unify has weathered many storms in the textile industry, including the decline of polyester in apparel and the extreme price pressure from foreign imports that resulted from the World Free Trade Act. However, they've not only just survived when many of their competitors did not. Unify has grown to be the largest U.S. supplier of textured nylon and polyester. They have a near global presence, and they currently employ 2,900 people worldwide. In addition to their original polyester offerings, Unify now offers a variety of spun and filament products at various levels of the value-added chain, including partially oriented yarn that they sell to other yarn manufacturers, and Reprieve recycled polyester chip, which they sell to non-textile industries. Unify is an international organization. They have many key players, but I've listed above some of the primary executive leaders. There are several ratios that we can look at when we're looking at the key financial information. The current ratio and working capital are good measures of the short-term financial health of an organization. Unify has a current ratio of 3.23, which indicates they have over 3 times the short-term assets needed to cover short-term liabilities. This, combined with their high working capital, puts them in a strong financial position. We also want to look at the return on equity. It's otherwise known as the DuPont formula, and we can break that down and look at several key metrics that are part of the DuPont formula. They have a profit margin of 4.67%. We'll look at the profit margin trends a little bit later, but Unify started out using a low-cost strategy, and those commodity products are still a large portion of their sales dollars and inherently bring a lower margin. Unify's asset turnover is 1.16, which is pretty reasonable for a manufacturer due to their high level of capital investment. And finally, Unify's financial leverage is 1.56, which indicates that less than half of their assets are financed. Overall, Unify has a return on equity of 8.45%. This is a little bit lower than typical S&P 500 companies that have a 10 to 15% return on equity. However, Unify as a whole is very healthy from a financial perspective. And a final quick look at some of financial data shows a couple of trends that tie in well with Unify's current strategy. There was a downward trend in net sales through 2016. This trend started to reverse in 2017 and 18. Interestingly, the lower sales corresponds with higher profit margins. There's been a slight downward trend in profit margins from 2015 to 18, which I believe is in part a result of increased selling expenses that go along with the sales strategy that I'll outline in a future slide. For now, let's jump into the business level strategy. Every good strategy is anchored by a solid vision and mission statement. Unify has done a good job of clearly communicating where they want to be in their vision and mission statements. From those statements, 2 key words jump out: performance and sustainability. These are the anchoring terms for Unify's current business level strategy. And their business level strategy is a strategy of product and or service differentiation, with product differentiation being what their long-term goal is. Unify currently has 2 major segments of business: the commodity textured nylon and polyester business, and what they refer to as premium value-added products. Over the long term, Unify is emphasizing growth in the PBA portion of the business. However, Unify still currently relies on the volume of the commodity business as well. In an interview with a VP of brand sales, Chad Bullock, Chad indicated that Unify cannot compete in these commodity items on a low-cost basis with foreign imports or even some of the domestic manufacturers. Unify tries to differentiate these commodity products with service and quality. This portion of the business remains at about 55% of Unify's total sales. Now, premium value-added products are the major source of growth for Unify, and that's according to an Investor Day presentation that was made in 2018. PBA is currently at 45% of total sales and accounts for almost all of the sales growth. Now, these PBA products come in a variety of styles and types, and they are a combination of sustainable products such as Reprieve and performance products such as odor-resistant, UV protection, and thermal regulation fibers. And I've listed above a few of the PBA products that, that Unifi offers. There are several more on their website. In conjunction with the differentiation strategy, Unifi has employed a pull strategy for marketing and sales. Unifi is directly marketing to brands such as Nike, Adidas, Under Armour, etc. And then once the brand has the buy-in, they will pull the product up through the supply chain. Unifi still maintains their sales and technical support to their direct customers, but this pull strategy in conjunction with a strong brand recognition strategy has resulted in an increase in selling cost as a percentage of net sales. The increased selling costs may also explain the slight downward trend in profitability over the past couple of years. However, as these selling costs level off and the PBA products grow as a percentage of sales, I would expect that the profit margins would begin to increase again. Unifi has employed vertical and horizontal integration as a part of their corporate level strategy. Consistent with their business level strategy, Reprieve is the most vertically integrated product they offer. With this product, Unifi starts all the way back at bottle collection, produces the recycled chip, extrudes the fiber, texturizes and dyes the yarn. At this point, the yarn is sold to various weavers and knitters. At various stages in the value chain, Unifi also sells products such as Reprieve chip that can be used by non-textile applications and partially oriented yarn that is used by other filament texturizing plants. Unifi also maintains its own trucking service. In addition to the vertical integration, Unifi has acquired several operations throughout its history. Some were competitor buyouts and others were opportunities to increase diversification by entering new markets. The most recent of those acquisitions was the purchase of Glen Raven's texturizing yarn business in May of 2018. And we'll take a closer look at that particular acquisition. With this acquisition, Unifi was able to do several things. They were able to gain a foothold in the polypropylene business, which will increase their diversification. This acquisition greatly increased the texturing capacity, which Unifi considers a core competency. They were also able to enter new markets for current products such as industrial upholstery and high-end apparel. And then finally, Unifi was able to fold Glen Raven's dyed yarn business into its own dye house. This will put that dye house close to full capacity, which will reduce cost and increase efficiency. In the last segment of this presentation, I would like to outline a TOES matrix based on internal and external factors. The first recommendation I made was that Unifi develop a sustainable nylon option. This recommendation is based on Unifi's research capability and the brand recognition of Reprieve. Currently, there is an upward trend in the demand for sustainable products, and in addition to that, nylon prices are increasing due to a raw material shortage. The second recommendation is for Unifi to expand the manufacturing of Reprieve to a location near Europe or Asia. This will reduce their manufacturing cost of Reprieve and provide a lower shipping cost to those markets, and this will help overcome some of the higher manufacturing cost that is limiting the sales of the product currently. The third recommendation I made was to develop accepted industry practices for certifying recycled content. Now, Unifi currently uses a fingerprint technology, which is a step in the right direction. However, they really need a full-out accepted industry practice in order to protect against the threat of fake recycled products. Recycled products in general cost more to manufacture, so there is an incentive for companies to label a product as recycled when it is not, and Unifi will have to work to be able to sidestep that threat. Finally, I made a recommendation that may be a little bit controversial, but I feel that Unifi needs to discontinue expansion initiatives that rely on the sale of commodity goods. They've done a great job in pushing their PBA products, but it's going to be easy in the long term for them to straddle or to try to maintain those commodity products in order to sustain their current growth rate. However, they're really not, with their higher manufacturing cost and the erosion of commodity pricing, it's really going to be tough for them to compete in that market. So Okay, this concludes my presentation. I hope this has given some insight into Unify's strategy. Thank you for listening.